Every empire that has ever existed has faced economic downturns. From ancient Rome's currency debasement to the Great Depression, recessions have been an inescapable part of human economic history. The word recession strikes fear into investors, business owners, and workers alike. Today, we're pulling back the curtain on recession economics, the forces that drive boom and bust cycles, the warning signs most people miss, and how you can not just survive but potentially thrive during economic downturns. The economy doesn't move in a straight line. It pulses like a heartbeat through predictable phases. This economic cycle has four distinct stages that economists have observed for centuries. The expansion phase is when the economy grows steadily. Businesses hire more workers, consumers spend more money, and prosperity spreads. Think about the roaring 1990s tech boom, or the housing expansion of the early 2000s, periods when economic optimism seemed boundless. Expansion eventually reaches its peak, the second stage. At the peak, the economy hits maximum output, operating at full capacity. The late 1990s dot-com frenzy represents a classic peak, when stock valuations soared and economic exuberance reached fever pitch. Next comes contraction, when economic growth slows, then turns negative. Businesses become cautious, reducing investments and workforce. Consumer spending declines as people grow concerned about financial security. The 2008 housing market collapse triggered a severe contraction as property values plummeted and financial institutions faced crisis. Finally, the economy reaches its trough, the bottom of the cycle. This is typically the worst point of a recession, when unemployment peaks and economic output hits its lowest. The early 1980s recession saw interest rates above 20% and unemployment near 11%. A painful trough that reshaped the American economy. From the trough, the cycle begins anew as recovery takes hold. Technically, a recession occurs when GDP, the total value of all goods and services produced, declines for 2 consecutive quarters. But this clinical definition fails to capture the human reality. A more comprehensive understanding includes rising unemployment, declining consumer confidence, reduced business investment, and credit contraction. The National Bureau of Economic Research looks at all these factors rather than relying solely on GDP numbers. Recessions transform the economic landscape. As demand falls, companies lose revenue and often respond by laying off workers. Those unemployed workers then have less to spend, further reducing demand, creating a negative feedback loop that deepens the recession. Most recessions stem from one of two economic disruptions: supply shocks or demand shocks. A supply shock happens when something suddenly interferes with the economy's ability to produce goods and services. The 1973 OPEC oil embargo exemplifies this. When Middle Eastern oil producers cut exports to the United States, oil prices quadrupled almost overnight. Since oil was critical for manufacturing, transportation, and heating, this supply shock rippled through the entire economy. Production costs soared, businesses struggled with profitability, and growth stalled. A more recent supply shock occurred in 2020 when the COVID-19 pandemic disrupted global supply chains. Factory shutdowns in China meant fewer goods reached American shores. Microchip production couldn't meet demand, causing shortages in everything from cars to gaming consoles. These supply constraints contributed significantly to economic contraction. Demand shocks occur when consumers and businesses suddenly reduce spending. The 2008 financial crisis exemplifies this. When the housing bubble burst, Americans watched their home values plummet. Many found themselves underwater on mortgages, owing more than their homes were worth. This destruction of household wealth led consumers to drastically cut spending. Simultaneously, banks tightened lending standards. The resulting collapse in demand caused the deepest recession since the Great Depression. The 1929 stock market crash triggered another infamous demand shock. When stock values collapsed, so did the wealth of many Americans. Consumer spending plummeted, businesses closed, and unemployment soared to 25%. The Great Depression was essentially a massive, prolonged demand shock from which the economy didn't fully recover until World War II military spending boosted demand. Central banks like the Federal Reserve play a critical role in both causing and addressing recessions by influencing interest rates. When the Fed raises rates to fight inflation, it deliberately slows economic growth by making borrowing more expensive. The most dramatic example occurred in the early 1980s when Fed Chairman Paul Volcker raised interest rates to unprecedented levels to break inflation. The prime rate peaked at 21.5% in December 1980. This monetary tightening triggered a severe recession, but ultimately succeeded in controlling inflation. Sometimes, the Fed's efforts to prevent economic overheating go too far. In 2018, the Federal Reserve raised rates 4 times, continuing a tightening cycle that began in 2015. By late 2018, signs emerged that these hikes were significantly slowing growth, particularly in housing. The Fed ultimately reversed course in 2019, but not before economic growth had substantially decelerated. Many of history's worst recessions have followed financial crises, periods when banks fail, asset prices collapse, and credit becomes scarce. The 2008 Great Recession perfectly illustrates this connection. For years leading up to 2008, banks had been extending increasingly risky mortgage loans. When housing prices began to fall and mortgage defaults increased, financial institutions that had loaded up on mortgage-backed securities faced insolvency. Lehman Brothers collapsed in September 2008. Other financial giants required government intervention to survive. As banks stopped lending, this credit freeze spread to the broader economy. The resulting recession was devastating. The U.S. lost 8.7 million jobs, the unemployment rate doubled to 10%, and $19.2 trillion in household wealth vanished. Housing prices fell 30% nationwide. The economy didn't recover its pre-recession employment level until 2014, 6 years after the crisis began. Economic downturns aren't purely mathematical events, they're deeply psychological. When consumers and businesses become pessimistic, they change behavior in ways that can accelerate recessions. British economist John Maynard Keynes called this the paradox of thrift. When individuals sensibly save more during uncertain times, their collective reduction in spending weakens the overall economy, potentially making everyone worse off. This psychological feedback loop explains why consumer confidence surveys are closely watched economic indicators. Widespread pessimism can become a self-fulfilling prophecy. When recessions strike, governments typically deploy 2 powerful tools: fiscal policy and monetary policy. Fiscal policy involves government spending and taxation. During recessions, governments often increase spending on infrastructure, unemployment benefits, and other programs designed to pump money into the economy. They may also cut taxes to leave more money in consumers' pockets. Monetary policy, implemented by central banks, focuses on controlling interest rates and the money supply. During recessions, central banks typically lower interest rates to encourage borrowing and spending. After the 2008 financial crisis, the Federal Reserve slashed its benchmark rate from 5.25% to nearly zero and implemented extensive bond buying programs to support financial markets. Economic downturns are inevitable, but their impact on your personal finances isn't. With strategic planning, you can significantly reduce your vulnerability to recessions and potentially even capitalize on the opportunities they create. First, build an emergency fund that covers 6 to 12 months of essential expenses. During the Great Recession, those with adequate cash reserves avoided the devastating spiral of missed payments, debt accumulation, and credit score damage that trapped many Americans. Your emergency fund should be kept in FDIC-insured accounts, where it remains accessible regardless of market conditions, reduced fluidly, not spaced out, before a recession hits. Credit card interest rates often exceed 20%, creating a financial drain that becomes unbearable when income drops during economic contractions. Many who entered the 2008 recession with minimal debt emerged financially intact, while heavily indebted households faced foreclosures and bankruptcies. Third, diversify your income streams. The pandemic recession revealed the vulnerability of single-income households and those working in heavily impacted industries like hospitality and entertainment. Developing side hustles, freelance skills, or passive income sources creates financial resilience when primary employment becomes unstable. Fourth, position your investments strategically. Historically, certain sectors perform better during economic downturns. Consumer staples, healthcare, utilities, and discount retailers often demonstrate recession resistance. During the 2008 financial crisis, while the broader market collapsed, discount retailer Dollar Tree saw its stock price rise over 60% as budget-conscious consumers sought affordable alternatives. Fifth, consider maintaining some liquidity for opportunistic investments. Warren Buffett famously deployed capital during the 2008 crisis, making investments in companies like Goldman Sachs and General Electric that later yielded enormous returns. While most people lack Buffett's resources, having some capital available when assets are undervalued can accelerate wealth building. Sixth, invest in your skills and adaptability. The COVID recession accelerated automation and digital transformation, eliminating many jobs permanently while creating new opportunities. Workers who continuously develop in-demand skills and demonstrate adaptability have proven more recession-resistant throughout economic history. Finally, maintain perspective. Recessions, while painful, are temporary. Every economic contraction in American history has eventually given way to expansion. Making panic-driven financial decisions during downturns like selling investments at market bottoms or abandoning long-term financial strategies often causes more damage than the recession itself. Understanding recession mechanics helps us recognize warning signs of future downturns and position ourselves accordingly. Recessions, for all their hardship, also create opportunities for those who prepare. They redirect capital toward more productive uses and often accelerate innovation as entrepreneurs seek solutions to new economic challenges. Until next time, this is the Wealth Squad, and don't forget to get money by income. If you found value in today's exploration of recession economics, hit that like button, subscribe to join the Wealth Squad community, and drop a comment sharing your own experiences with economic downturns or questions about preparing for the next recession.